Alright, what's up traders? So in today's video, I'm going to talk about the thing that I think is probably the most important part about trading, and that's the journaling and statistics gathering of the actual trading. So I'm going to go through a couple of things that I like to look at and how I like to journal and the process that I got for journaling my trades. Alright, let's go. Alright, so first of all, I just want to say thank you to all of you. Like, you guys are the best, right? The feedbacks that the feedback that I've been getting these last couple of weeks, and I mean, you guys rock. So thanks a lot for that, and I really do appreciate all of you. Alright, so you can see above me here, I have the Discord, the Birdnest Discord, my private individual traders channel in the Birdnest community server. So if you don't know about the Birdnest, go to birdnest.com, check it out. So this is a text that I wrote yesterday, and this was just after I recorded a 1 hour long video for my private students where I kind of went through my journal, and the journal I'm using is the Edgewonk journal, and I kind of went through the whole process. I don't really feel ready to share all the details of my trading journal with with all of you on YouTube, because it's quite a personal thing, right? So I'm gonna keep it private with my private students. If you're interested in checking out my personal journal and exactly how I trade and everything like that, check out the private mentorship program in the Birdnest. You can find a link in the description below. So right here, as you can see, I've written. And let's see if I can pull up the screen on the picture here on the bigger screen, so you can see better what I'm actually looking at, right? So I went through my journal, and I've added a couple of things here. So the reason for wanting to have a journal in the first place is, like, you gotta run your trading just the same way as you would run a business, right? You need a business plan, and you need to get the statistics on what you're selling, how much you're selling, the profits and loss, and get the statistics on what your customers actually is actually buying and what they're actually liking and stuff like that, to improve the business, right, and make it more profitable. Just the same way you need to really run your trading as a business, where you need to you journal all your trades, see what works and see what doesn't work. So if you find something that works really well, you need to continue doing that until it stops working. And if you find something that's not working very good, you need to take notes on that and really learn from your mistakes, right? Because trading is all about trial and error, right? You try to find the things that work and you keep on doing that. And you try to find the things that do not work and you stop doing that or improve until it's working. So I went through my journal from last week, and something that was quite obvious was the fact that throughout the whole week, I noticed that if I would have waited for confirmation instead of just blindly setting orders where I thought price were going to reverse, and this is something that I know this, it's just trading is a big, it's a mental game, right? You need to have strong discipline and be very patient, right? So I remember watching the journal and kind of saw that, well, if I were to wait for confirmation, my win rate would have been higher and I would not have entered as many losers as I did, because some of my trades were used, I put in orders where I thought price were going to reverse, and instead of waiting for confirmation, I just blindly put in orders and they went straight through that level. And I'm going to show you an example on just that. Alright, so this is a Euro GBP chart, and I remember I were looking at taking a short on, a long on Monday or Tuesday, and I was looking at this this level right here. I wanted to long that level right there because the GBP were coming out with some bearish news, and I was expecting the Brexit talks to be yet another disappointment. So I was looking for GBP to dump and the euro to show strength versus the GBP, and I kind of like this breakout right here. So what I did was I started layering bids inside this zone with a stop somewhere below this area right here, and as you can see, prices came straight down to my level where I wanted to buy and just dumped straight through, and then it actually came up again and had a bearish retest of that area. Now if I were to wait for confirmation, and what I mean by confirmation is just I'm gonna make videos on exactly what I look for in confirmation, but that's not really part of this video. The reason why I wanted to show you guys this is the fact that if I were to wait for confirmation, this would not have happened. All right, so another thing that's very, very important, and something that I've seen, a mistake that I did on a pretty big potential winner, was the fact that I exited the position where I thought, this is going to be the top. So I exited the position instead of letting it run, and it did run quite a bit. I would have made double the amount I did if I were to have just waited instead of exited the position. So like I've written here it says, let winners run, never exit fully, always exit last part of the position with a trailing stop. Let me show you what I mean by that. All right, so this is the Euro JPY chart right here. So let me explain how I play this, right? So this is a RLC to RLC setup, and again, I'm not going to go into detail on the specific setup. I'm going to make more videos on that later. This is just for the journal aspect, right? So you can see here, price comes down into the long RLC, bounces up to 618, and comes up to the short RLC. Now, I sold some at 1R, sold some at 1R, pulled my stop loss into the entry area for a free trade, and then I took some more profits up here. So I think I had like 25% of the position still open when I decided to sell here. Why? Because it had a pretty nice reaction up to 618, and instead of actually selling, instead of actually getting out of the position right here, I could have looked at the 1 hour, right? So I could have looked at a 1 hour, and I saw a reaction right here and a bounce off that fib level right here. I could have instead just put in a stop loss right here. So I could put in a stop loss right here, price comes up, gets reacted here, another swing low right here. I could have then put in a stop loss here, right? And I would have been stopped out here instead. So that's something that I'm gonna work on. Whenever I think I need to take profits, whenever I think, whenever I get the feeling where, all right, this is the top, I need to take profit here, I can't give my profits back to the market. It's important to remember that I've most likely already taken most of the profits out of the market, and this is now a free trade. It's just better to put a stop loss below the current price structure, right? And what I mean by current price structure, this is the price structure I'm looking at, right? So this is a take profit area, but instead of actually taking profit here, let's just put in the stop loss here. I'm gonna lose, obviously, if I get stopped out here, but it's very important in the long run to let your winners run. I'd rather lose a little bit of my profit if it means that someday in the future I'm gonna get that big winner, which will maybe make my whole month, right, in one trade. So it's important to really let your winners run, because, and this is something that you're gonna realize too when you start a journal, when you start gathering the statistics. I mean, you got to think in probabilities, and you got to think in hundreds and thousands of trades. You're going to think like, all right, so if my risk to reward ratio is positive and my winners is much bigger than my losers, I'm going to make a lot of money in the long run, right? In the long run, that's what's important here. So let your winners run, sacrifice some potential profits for that probability of making big winners. All right, so another thing that I've talked about here is, as you can see here, I've written take fewer trades. Why do I need to take fewer trades? Well, I had the Monday was a very good day. Monday was an extremely good day. I had I made more money in the first 3 hours on Monday than I do in a whole month, right? The problem though is that Tuesday comes along and I got overconfident from Monday trading, and I started just over trading. Like I started just taking trades all over the place, like just taking trades. I was overconfident, just taking a lot of trades. I was over trading, right? So I realized that, all right, so I need to put in a rule here. I need to put in a rule, and that rule is going to be, I'm not going to take more than two trades a day, right? So this week right now, I'm not going to take more than two trades a day, and I'm going to journal that next weekend to see if it's going to improve my performance, if I am very picky with my trades and take way less trades. And as you can see here, another thing that I've written is this active risk limit. And by active risk, I mean how much risk can I have in the market at any given point. And I've decided 4% active risk because that's a comfortable number, right? That means I can have, if I use 1% risk per trade, I can have four open trades with 1% risk on each. If I move stop loss to entry on one of those trades, I have effectively minimized my risk to 3% active risk in the market, so I can open up a new position, right? And risk per trade is going to be 0.5 to 1%, because I actually saw that when going back and looking at the journal, I took one trade where I risked 2%, and because of the way I layered my orders, I actually lost like 2.5%. So gotta be more careful with that, and only risk maximum 1%, right? So I can't get overconfident and increase risk. I need to be very consistent with my risk taking. So active risk limit 4%, and risk per trade is going to be 0.5 to 1%. And this last part right here, the where I've written always, well, it's not the last one, I'm going to talk about the daily trend too, but this one right here is always TP at the 618, front run a little on the RLC to RLC setup. So obviously this has to do with the RLC to RLC setup, and I'm going to show you the reason why I've written that I always have to take profits at the 618. All right, so first of all, I got stopped out here because of the slippage, so I did not think about the actual slippage because I was trading the lower time frames here. I'm used to swing trading the higher time frames, but I saw a very good setup on the low time frame, so I made a mistake not factoring in the slippage and the spread on Australian dollar USD here. So I got stopped out right here, but it doesn't really matter because like my original take profit was up here, and if I were to have my original take profit up here, I would have gotten stopped out, right? But if I were to take the profits at the 618 of the short RLC and have my stop a little bit wider, this would have been a I would have been in profit on this first trade, right? So that's very important. That this is something that I've realized while looking at all my trades with the RLC to RLC setup. Is something that I've noticed, that you need to take profits at the 618 and not in the middle of the short RLC. So you enter on the 618 and you take profits off the 618. So enter 618 long RLC, take profit 618 short RLC. And then we have this last part. Do not trade against the daily trend. And then I've written define the daily trend, and this is something I talked about with my private students, right? So I got to define like what is the daily trend, and then we talked about, is the daily trend whenever price is above the 200 EMA with the 200 EMA going upwards, or is the daily trend when the daily market structure price action market structure is up with the 200 EMA up? Do the market structure, the price action market structure have to align with the bullish or bearishness of the 200 EMA? So that's why I've written define the daily trend, and I've come to the conclusion that the daily trend is strong when the market structure is bullish. I could say so the daily trend is strong when the price action, the market structure on the daily is confluent with whatever direction the 200 EMA on a daily is, right? So whenever those two do not align, I would view the daily trend as neutral, and I'm not going to be trading in neutral trend either. I'm only going to be shorting whenever the daily market structure is bearish and the 200 being below the 200 EMA, and I'm only gonna long whenever the daily market structure is bullish above the 200 EMA. So these are kind of broad, like these are kind of broad but specific things to look at on the daily, and I do realize that I'm not gonna be able to find many trades that are where the 200 EMA and the market structure kind of aligns perfectly. So that's also a good reason for me to take fewer trades, and it's going to help me to stay patient, wait for confirmation, and take fewer trades. All right, guys, I think that's everything that I wanted to talk about today. And with this, I just want you guys to realize how extremely important it is to journal your trades. I'm gonna make way many videos on this subject because I think that's the single most important part about trading. Let me just leave you guys with this. You can have a win rate of 25% and still make money if you have a high risk to reward ratio. If your winners are big enough, you can have a very low win rate. If you have a 50% win rate, you only need a 1R to become, to be at break even. If you have like 1.5 or 2R, if you have, I think it's 2R. If you have 2R, you only need to win 33% of your trades. So with this, I want to say win rate means nothing. Risk to reward means everything. And you're not going to have any idea what your win rate are or what your average R is if you don't journal. You're never going to understand what you're doing right or what you're doing wrong if you can't journal. So what I'd like you guys to do is get a pen and paper at least. Make a trading plan. Describe yourself as a trader. Describe your trading style. Get a simple Excel sheet. Members of the Burb Nest probably got this already from me, but it's just keep it simple. Journal your trades. Go back at all trades on the weekends. Look back at the week that have the trading week, and just look at what you did right and look at what you did wrong. Trading is a trial and error. You can make money with a bad trading system and good risk management and good journaling, but you will never be able to make money in trading with a very good system, a very good trading system, but with bad risk management and bad journaling. So, very important. All right, guys, that's it for me today. Take care, everyone, and see you guys next time.